Hello. For those of you who have spoken to me over the past few months, you know that one of the things I've been harping about is FinTech. So I wanted to briefly introduce that topic. This is going to have to be part one of a multi-part series. Of course, when I'm talking about FinTech, I don't mean financial technology. I mean forcing investment newbies to exacerbate conventional howlers. All right, what do I mean here? What I mean is FinTech has a propensity to exacerbate behavioral finance mistakes in its users. Okay, so let me explain that a little bit more. Again, I think FinTech is a fantastic technology. I really like it, but however, there are good and bad components. So on the good side, look, it's allowing access to individuals outside of traditional channels. So that means we have more people investing, more people with full service financial help. Right? It's going to attract younger individuals. We all know that the key to saving for your retirement is to invest sooner and more often with more money, right? It's super easy. You can do it right there on your phone. This is fantastic. And it's relatively painless. Some of these fintechs allow you to round up purchases and automatically invest it. So you're rounding up pennies, you're investing pennies over time. It's painless as you do it, but it truly does add up over time, right? On the flip side of the coin is the bad, right? The other thing that's bad about it is it's so easy, right? You can literally buy and sell stocks in the line at a grocery store, right? We already have attention spans that are less than those of goldfish, all right? So in the line at the grocery store, are you conducting proper research on your stock selection, your stock buys, your stock sells, right? I think this is leading to extremely short-term investing, right? We all know that stocks are supposed to be long-term investments, right? There's a million other things I could go into here, and I will go into in later iterations of this series. But the bottom line is, these technologies really allow you to amplify the behavioral mistakes that all of us, even sophisticated investors, make. Okay, so I've been talking about this for months. I was just recently introduced to this Robintrack website. Okay, so Robintrack tracks user holdings on the Robinhood app. Okay, and I've noticed a distinct pattern here. The really popular stocks on this app seem to be kind of like the buy the dip strategy, right? So you see a stock, probably when you're familiar with, right? It's a household name, and you see that the stock is trading at a really, really low valuation, right? So you buy it, and you can see that here for two companies. Okay, the problem is both of these companies are going through bankruptcy. So the most likely outcome for these investors is going to be that their investment goes to zero. All right. There are other patterns that I want to explore and try to find on there that I'm expecting to find. But here's two examples of individuals buying stocks because they're low and they seem like a bargain price, probably not realizing that they're likely to go to zero because of bankruptcy. All right. So the silver lining in all of this is that because of the fintech technology, they can probably offer a solution to some of these problems. I want to go into that in one of the next versions of this video series. Anyway, thank you so much for listening. Enjoy the rest of the week.